On a portfolio invested 100% in equity, you would say arguably half of it would be in your country or your area, so at least 50% in Europe. The rest would be diversification in outside of Europe. US is obviously very big, so it's a matter of, from a European investor to choose how much they're going to put in the US, how much they're going to put in other countries. And other countries is mainly emerging countries.
Die Geldmeisterin. Der Finanzpodcast mit Julia Kistner.
My name is Bruno Varnier. I am the founding partner of GEMway Assets. I've set up GEMway Assets 10 years ago in 2012 to manage a GEM equity, which is a fund we set up at that time. It's a global equity fund invested in global emerging markets, equity, listed equity. The fund now is a bit over €1 billion. So altogether, we manage €1.2 billion in emerging countries.
Mm-hmm. And how come that you specialized in emerging markets?
Well, I've been in emerging markets ever. I've started my career in Asia, in Thailand, back in 1988, working for a French bank at that time. I moved in 1989 to Hong Kong. On the investment side, Malaysia, Indonesia, Philippines. So I was an analyst there, and quickly I started to manage funds as well. I came back to France in 1995 and joined Edmond of Rothschild to manage the Asia ex-Japan fund. And I stayed there with them 16 years.
So you're really an expert. To start with, what is an emerging market for you? Is China still an emerging market?
There's a definition by a global institution of what is an emerging country or an emerging market country or what is not. And this is related to GDP per capita and the kind of economic growth they can have. From that point of view, China is very much an emerging market. It's a number one emerging market, I would say, or some argue that it's a mother of emerging markets. But it was not before. About 35 years ago, China was non-existent from a financial standpoint. It was zero in the indices. There were no listed companies there. The first listed company started in 1993. And obviously, it has evolved from zero to at the top, it was 42% of the global emerging market index. That was in October 2020. At that time, Alibaba, which was the number one stock in the index, was over $1 trillion market cap. Unfortunately for Alibaba, for Tencent, those names have come down substantially. And the China weighting within emerging market index has gone down from 42% to 32% now.
I got to know the emerging markets with Jim O'Neill, Goldman Sachs, 21 years ago. The concept of investing in these four fastest growing emerging markets players: Brazil, Russia, India, China, BRIC. Yes. Are these four countries still the engine of the emerging markets? Two haven't been so far the engines. If you think of, I would say, Brazil and Russia. What has changed so far, and where do you see right now the engines of the emerging markets?
Okay, well, it was a very interesting marketing concept at that time, and many funds have been set up on that concept ever since. I can say that, of course, India, China, because of their population, are a very strong growth driver for the world. And China in particular, since the size of its economy now. Brazil, to a lesser extent, is also a big economy for Latin America. It's the largest, by far the largest, and it's a big driver as well. Russia used to be a not insignificant driver of what's going on in emerging countries. Obviously, with what happened last February when Russia invaded part of Ukraine, Russia put itself outside of the investment grid, I would say. So Russia is not there anymore in a way from an investment standpoint, although from a real standpoint it's still very much there. having negative influence right now because of what's going on in Ukraine. So I wouldn't say those 4 countries are engines of emerging countries now. India and China are definitely engines. They are. Brazil is smaller. Russia is non-existent for the moment. As I said, it's been much more of a marketing concept. The reality was, of course, they were big, so they are the major emerging countries. But there are others emerging countries, obviously, which have emerged in a bigger way now, like Saudi Arabia, for example, which is 5% of the global emerging market index, which was not there back 21 years ago when Jim O'Neill invented the concept of BRIC, right? In a way, from the energy point of view, Saudi Arabia has replaced Russia in this concept, I would say. As far as our investment strategy is concerned, sometimes we've been very keen on each of those countries, on each of these markets. Sometimes we've been less keen, obviously. China has always been a big part of the portfolio. China is very deep in terms of investment opportunity, to a point that what is really important in your strategy is not so much the GDP growth of China, but where you're going to invest or the sector where you're going to invest. The growth of this sector will be much more important. There's many sectors in China which have seen their growth declining, and for good reason. The property market, has been becoming smaller in terms of contribution to growth. The infrastructure, whether it's road infrastructure, have been very strong at one point of time in the last 25 years. Is much less now because infrastructure has been built, and you don't build high roads for 10 years, while you buy them for longer than that. The opportunities in China are much more now in technology, consumption. The consumer in China is very important. It's becoming a big consumer relative to the rest of the world. Important for not only for Chinese companies, but also for global companies selling stuff in China. It's particularly relevant for the luxury industry. Being French, I'm a bit concerned by what's going on for LVMH or by Hermes, right? Both companies are selling a lot to Chinese buyers.
Mm-hmm. But it takes a long time to get this kind of brands. But if you think of sport brands, they are much more in competition with the Chinese brands.
It's true. Although Nike has also been quite successful. It's been successful in China, Adidas as well. But it's very smart to point out that you have the emergence of local brands. And it's particularly the case in China, and it's quite recent, actually. In a way, there's a bit of change in the behavior of particularly the young Chinese consumers who are more keen to buy local brand than foreign brand.
Are they keen, or is it the government that...
At the end of the day, they choose. The government can do a lot of things in China, but they're not telling you what kind of shoes you should wear, right? It's up to you. If you have the money, you can buy Nike. Nike is more expensive than a local brand. On the margin, we've seen increasing interest for local brand. For example, Li-Ning is a local brand. Li-Ning, and this has been a very successful brand in China. The shoes they're making are more expensive than the average shoes, sport shoes they do, are made by local brand, but they're cheaper than Nike or Adidas, arguably.
So you have to have this in mind if you're investing in companies like, as you said, H&M or Adidas or even Volkswagen, because they are all substituted by Chinese brands?
To a certain extent, some of them are substituted definitely by local brands. It's the case in China. It's also the case elsewhere, maybe to a lesser extent.
In India also?
In India as well. In India, the local brand has always been very important. For foreign brands, it's been tougher because the level of tax is much it's been bigger for foreign brands. arguably the Indian household has less money available to buy discretionary items, and they prefer cheaper brands, which are mostly local brands. Again, here we see change, and because the consumer sector overall in emerging countries is evolving, is becoming more and more important, because those countries are richer than they were before, although they may not be as rich as Western countries yet, but they're definitely richer. And they're more populous, right? I mean, even a small proportion of rich Indian or rich Chinese will make a big number compared to what we have here.
And this will even hurt these luxury goods, like you said, Hermes or LMK.
We have not seen yet, and I stress the word yet, brand competing with Hermes, for example. Hermes is still considered as such a top brand. We don't see yet a competitor to that brand in the kind of price segment Hermes is, right? But at the lower level, we see definitely competition by local brands.
And to get back 21 years ago with Jim O'Neill and BRIC, why do you think China has developed so much better than the other three fortress countries?
That's a very good question and a very complicated question. There's no doubt that the GDP of China has increased tremendously. The GDP per capita has increased tremendously. The level of investment done by China has been tremendous, much bigger than any other country, including Brazil, India, or Russia, the last 25 years. As the role of the government has been very, very strong. They didn't hesitate to invest heavily in infrastructure, much more so than any other country. Better infrastructure makes business environment easier, right? So they provide an environment where local private entrepreneurs could evolve, right? In a much bigger way than any other country in the world the last 25 years, I would say.
And what has changed so far that you are now keen on India and Brazil? Why should they develop now better than 20
Well, of course, the level of development in China has come to a point that the growth, expected growth for the next, say, 5 to 10 years will be less, right? It doesn't mean it will be of less quality, actually. We expect a fairly strong growth by the consumer sector in China. The consumption in China is around 50% of GDP. You can expect that if China is becoming more like a Western country, the contribution of consumption will be more. Maybe not to the same extent as what we see here in the West, but at least it might go to 60-65%. So the expected growth of the consumer sector in China is probably interesting and quite good to look at.
But why do you then still under or be neutral?
Yeah, but because the level of GDP growth is not necessarily a key criteria for your investment decision. It's stronger growth is always better in a way, but strong growth in China has also been a destructive kind of growth, where the money has been poured in some sectors where overinvestment has been done. So nothing is like 100% good or 100% bad, But nonetheless, the story of India now, or story of India of even the last couple of years, has been of a stronger growth, because the starting level is much less. The GDP per capita in India is much less. The population is much younger, so the potential of India is bigger at this point.
But you still don't have the middle class you have in China.
The middle class in India do exist, but it's very small. And of course, the expansion of that middle class is...
Nobody wants there.
It could be a huge opportunity, obviously, right? Providing the government is smart enough to provide the kind of infrastructure that can allow this private entrepreneurship to evolve, right? And we've seen this a bit. We've seen that the government of India has been quite quite good at this, I must say, has been investing, has been given tax incentive for investment to be increased. So the outlook for India is definitely good, very good for that, and might be better than China from that point of view, right? Having said that, from a stock market point of view, China has come down a lot, so there's a couple of opportunities in the short term that could be quite interesting, providing we have a change after the CPC, the Chinese People Congress, just Communist Party Congress. In India, we have a new cycle, which is also seen in the property. The property sector in India is booming, whereas in China is obviously not booming at all. So from that point of view, the confidence level is better in India. It is reflected in the valuation. India has done better in terms of stock market the last 12 months than China.
So you don't think it's overvaluated?
It's difficult to say. The valuation is actually quite high, no doubt about that, for India, but the opportunity is there. And from our point of view, we'd rather buy more expensive names with very strong opportunity than cheap names with no opportunity.
This is in general or just in India now?
Well, that would be general, but it's particularly the case when you compare China to India.
And how do you consider the political situation of emerging markets in your investment strategy?
Very, very important. So from a political point of view, you may have two kind of angle. First angle is a global angle. Is what's going on, for example, between China and the US, right? And it's been this relationship has gone basically from bad to worse, right? It's in a situation now which is pretty bad. Arguably, it could get worse, but it's more likely to stay bad than getting even worse, right? At this point of time. So, and the market valuation fully reflect that already. Obviously, what has happened with Russia invading part of Ukraine has pushed up the political risk premium overall, right? Not only for every market, including market in the Western world, right? So that's something you have to think about as well. And you may look at the oil sector as a hedge against those political uncertainty. Another angle is to look at domestically, really pure from one particular country, how is the political situation there. And some countries are in a more difficult situation because they may have some social unrest because of inflation, because of food price inflation. That would be the case maybe for Egypt, for a big chunk of Africa. For us, this is not investable markets. We don't invest in those markets. For countries which are arguably a bit richer, in Africa that would be South Africa, or Latin America that would be Brazil, Chile, Mexico in a way, or for Asia, very much most of Asia, this risk is less right now, although it's not equal to zero. Now, the kind of political change we've seen in some countries recently is not been particularly bad, I must say. In the Philippines, it's not. They've changed the government. It's not particularly negative. In Brazil, they're going to have election in a couple of days, right? Both candidates, we know them. So it's not like going to be a very big surprise. If Bolsonaro wins, then he will stay in power. That's no big change. If Lula wins, he's going to come back to power. He's been in power in Brazil for 2 mandates before. He was in jail as well. That's a bit more uncertain in a way. But again, given the kind of cabinet they are likely to choose, I wouldn't say it's a very big uncertainty, right? At least in the short term.
Okay.
Even if Lula wins. Right?
Some say it is riskier to invest in Europe than in emerging markets. Would you agree?
Well, if you're based in Europe, if you invest in Europe, at least you're not taking much of a currency risk, right? So, but you would have been better off the last 12 months at least to take a currency risk because the euro has been a bit weak, right?
Yeah, 18%.
Now there's a couple of risks in Europe that you may not have in a bigger way in emerging countries. The first one is the inflation or fueled by energy prices. Obviously, in Europe is a big issue right now. Mm-hmm. I don't see this situation to be settled in a matter of months. We have to change completely the supply chains. It's going to increase our cost of energy for some time, right? So that's inflation-fueled problem that you have less in emerging countries, because in emerging countries, source of energy are usually cheaper. Mm-hmm. Either they produce oil, in the case of Saudi, for example, in the case of Brazil as well, or they also produce other source of energy like coal. Most of the energy used in India or in China is coal-based, right? Mm-hmm. Mm-hmm. Of course, it's not particularly positive for global warming, but even in China, they said they want to be kind of carbon neutral in a matter of decades before 2060. So they want to increase renewable energy, but still coal is still going to be quite significant in the energy mix. And it's cheaper to produce electricity with coal now than with any other source.
Do you prefer emerging markets who are energy exporters, or doesn't this make any difference for you?
The two major energy exporters, the two major oil exporters are Russia and Saudi, right? Yeah. Russia is not investable right now. Saudi, we like it. Why we like it is actually because of oil price being a hedge against uncertainty, inflation uncertainty, and geopolitical uncertainty. Mm-hmm. As I said, emerging markets have an inflation problem, but it's a cyclical problem to me. Yeah? Mm-hmm. Long term, the energy bill is likely to be lower than the European ones, and the kind of pressure you have in the States, for example, on salaries, on wages, which we also feel here in Europe, is much less so of a problem in emerging countries. Because we have particular countries like India, for example, where the population or the young population is so big that we have nearly an infinite human resources that can put pressure, that can limit wage-wise.
What are your forecasts for emerging markets in general? And even you, I guess, won't invest everything in emerging markets. For a private investor, what should be the share in the portfolio? Well,
first thing first, for private investors, how much they want to put in equity. Right? Equity has a specific risk. It's more risky than bonds, more risky than cash, obviously. But let's say on a portfolio invested 100% in equity, right? Or the part which will be 100% equity. Of course, you would say arguably half of it would be in your country or your area, so at least 50% in Europe, I would say. The rest would be diversification outside of Europe. US is obviously very, very big and has been very successful. So it's a matter of, from a European investor to choose how much I'm going to put in the US, how much I'm going to put in other countries. And other countries is mainly emerging countries. I put aside Japan. Right? A neutral position would be more like 15%.
Are you just keen on emerging market equities, or are the bonds also interesting?
Bonds is actually very interesting now. The market, the bonds have come down. There's two components in bonds, right? There's the interest rate component. So when we are now living in a world where we have rising rates, particularly in Europe and the US. So this component is actually, as long as the interest rates are rising, it's quite negative bonds, right? Negative for US bonds, for European bonds. For emerging market bond, there's a component in the valuation of an emerging market bond which is linked to the interest rates and also linked to the US interest rates. So this part is still negatively impacted. The other part, which is pure on the emerging market risk, we call it the premium, right? This part actually has increased because the perception is that the emerging market bonds have been more risky. But I think this increase is not really justifiable, and we think it's too big now. Hence, so it's a perception of the risk is too big. Then it's attractive to buy it now. And on those bonds, EM bonds have come down quite a lot this year. I think they are a good investment in the short term.
Investments in dollar or in local currency?
In dollar. Even in dollar, your level of coupon would be higher than a straightforward US dollar bond, right? So, yeah, this premium that you make is interesting. So buy it in dollar, right?
Even though you talked about de-dollarization.
But de-dollarization is a long-term issue for the world, right? You know that now most of the global trade is done in dollar. Our country, they're buying oil in dollar. If anything, for example, we were buying gas in euro from Gazprom. Now we don't buy that much from Gazprom. We're buying more gas from Qatar, from the US. We're buying them in dollar. So actually this has contributed to higher dollar. Because before we were doing this trade in euro, now we're doing, so this is increase the dollarization of our trade in a way, right?
Because of the energy crisis.
Because of the energy crisis. Now, what we see in other countries, in particular with China, China has been doing business, selling, buying in dollar. From a country point of view, as big as China, this is unacceptable. Because it gives the U.S., the central bank of the U.S., the U.S. authorities, a control of what's going on. Because anything you buy in dollar is reported somewhere in a U.S. bank.
So this will change the digitalization of the currency?
You can argue that the use of Bitcoin and so on would be de-dollarization as well. But more importantly, China is trying to do business in renminbi, in its own currency. i.e. it means that China is buying a lot of things from the world. It's buying a lot of steel, iron ore from Brazil, from Australia. It's buying oil from Iran, from Saudi, from Russia. It says, well, I'm willing to buy this, but I want to buy it in my currency. So what does it mean? Of course, those currencies are not, so far they didn't really believe in renminbi. They say, well, this currency is not really a major currency, right? So before you can ask the world to use your own currency, you have to make sure that the world think your currency is a good currency. It's a strong currency. It's a Deutschmark. So what has done the PBOC, the Central Bank of China, over the last so many years? They have put everything in place so that to reinforce the reputation of their own reputation, the reputation of the central bank, and basically the stability of the currency. And arguably, the renminbi has been very stable, particularly against gold, actually.
It's still not free flow, though.
It's not really free flow, arguably. Yeah, exactly. But, now that what happened with Russia, in particular with the freeze of oligarchs' money, this can accelerate the move of other countries wanting to do business not in dollar anymore.
But the de-dollarization and I think the reserves of Chinese renminbis are worldwide 3% right now.
Yes.
So it's not much. So this takes a long time. So we don't have to hedge our US dollar investments right now because
no.
I need a dollar, that's what I need.
When I talk about de-dollarization, it's a long-term issue.
Yeah.
But nonetheless, it's a trend, and I would argue that more and more trade will be done in non-US currency. And this, if this is happening, and this is not happening overnight, this will happen incrementally. Incrementally, this is less demand of dollar. Since, at one point, we will be able to buy oil, for example, in other currencies than dollars, and you don't need that dollars, right? And China, which has $3 trillion worth of FX reserve, eventually, if they do more and more business in their own currency, they will need less of this reserve. So they will dump it. They will sell it. China selling $3 trillion is an impact on the dollar, right?
Yeah.
Of course, they will not do it overnight.
Not overnight, of course, because they have to export something. Yeah.
Exactly. So, yes, but as I said, they export, so they export to the US, they receive dollar, right?
Yeah.
They receive dollar. So that's a natural way of accumulating dollar for them. So if they can use this dollar back to buy a commodity from Brazil, for example. If tomorrow they are asking Brazil to accept renminbi, because Brazil will buy also manufactured product from China, and they say, you're buying this from me, you can pay in renminbi, right? So I am giving you renminbi for your iron ore. This renminbi you can use to buy telephones, to buy cars, manufactured in China.
To come to the end, do you see a deglobalization, and what does this mean for emerging market investments then?
So deglobalization is a long-term issue again here, and it's a long-term negative, I would say, for global. It means global deglobalization means less global trade in a way. So if you want to do a scheme on that, you say the world will become less horizontal, more vertical in a way. You're doing more business locally. You're buying things more locally than things that are coming from the other part of the world, right? And the global trade is all about producing the goods in the most efficient way, somewhere where it's most efficient way, and ship it to your place because it's less efficient to produce the goods here. So the bad part of this global trades will be the less industrialization in Western countries, and we see that politically has been becoming a big issue, right? And also an issue from an ecological point of view, right? Where you want less transport, you want to reduce the carbon impact. This is arguably makes the production of things more expensive. So this is a cut in the return on investment globally, right?
Globally,
And so, and it's been translated by valuation, which has come down. Now, of course, this issue is a long-term issue. It's not happening overnight. It's happening incrementally, but you have to keep this in mind, right? It certainly could be negative for countries which are benefit a lot from that, i.e. China, right? Could be negative eventually and Germany, not the matter. Could be negative as well for countries like Vietnam, which is benefiting a lot from that now. But really, it's a trend. So a trend, you can have some reverse short-term trend. So that's why you need to be careful upon acting based on that, right? You have to be really careful. Sometimes it has advanced too much, so you see some pushback. But nonetheless, it's globally negative long term. Yes.
That means also that we won't have these profits anymore as an investor in.
Yes. The value created by this optimization will be less. Having said that, keep in mind that as it is now, China has produced the largest ever trade account surplus in July. That trade account surplus was $102 billion for a month.
Does this also reflect already the shift of power?
No, it's more, in a way, it's more cyclical, because obviously China has been its economy has been slowing, so they're importing less, and they're still exporting a lot. The market share of China in global exports is 15% now. It's all-time high. So it has room to slow down a bit.
To slow down, okay. How do you want to beat the MSCI emerging market? What are you doing different? This is my last question.
I wish we can beat it every day and every month, right? Unfortunately, it doesn't work this way. No, that we have to remain true to ourselves. So for me, the key difference is to be able to select the best company. Of course, the cycle can be against you at one point of time. The big macro events can be against you, but usually it doesn't last too long. Whereas your ability to select the best company in a particular sector makes a sustainable outperformance, I would say. And we've been outperforming since the beginning in a big way. Some years have been particularly good. Some years have unfortunately been not as good. And the last 12 months have not been as good. But it doesn't mean that we're going to change the way we select companies. We've been, we're negatively affected by change in valuation in a way. That comes from globally higher interest rates, from change in the big macro. That is not so easy to foresee, actually, and we've not been lucky with that. But this big change in macro is settling down now. We don't expect big change in the macro in the next 12 to 24 months, because
even Taiwan could get.
Taiwan is it's another issue, I would say. But even if Taiwan happened, we are very underweight Taiwan. So, of course, we would lose a bit of money there if China was to invade Taiwan. But certainly we would lose much, much less than the index. So that would be a source of outperformance for us. Not a very positive one, I would say, but that would be on the negative, on the negative side. But put Taiwan aside, I think in China the situation will be more predictable after the Chinese
16th of October,
the Communist Party Congress. And do not forget that markets hate one thing, and one thing only: uncertainty. When it's more predictable, it's easier, right? So the volatility,
even though if it's still
Xi Jinping will be there. I mean, this is that would be such a big surprise if Xi Jinping is not reinstated. I think there's close to 0% probability for that. So, and the market would be not surprised, obviously, if he's restated. So this is not a negative issue if he remain there, because the market is already expecting this. Long term, of course, the fact that we have one man like this for too long is not good. We know that
everywhere
from history, not only in China but anywhere in the world. So that's a negative, but the market is fairly aware of that, right? And that's a very long-term concern. I think the next 12 months in China are likely to be more predictable. And that's a good thing. Now, whether it's going to be very, very good, I'm not sure.
But to keep wealth, it's still important to invest globally, because that's the best protection again.
Yeah, and in a way, that's a very important point you put out here, because we always say that diversification is good, right? But if everything is correlated, diversification doesn't mean anything.
Doesn't make sense.
If everything is going the same way, I mean, you might as well just buy your local market, right? Arguably, with this world being a bit less global trade, a bit more de-dollarized, although not so much, right? But with having different blocks as well, and growth coming more from domestic opportunities than global opportunities, I think the correlation of global markets will be much less. Now, also, there was such a big event the last 20 years, which was really where interest rates have been constantly going down. We moved from normal monetary policy to expand, a huge expansion of monetary base. This has pushed up everything in the same direction, basically. Some better than others, but globally in the same direction. Now that we are back to a more sensible monetary policy, and we're not there yet in Western world, actually, probably interest rate has to go up a bit more. As long as interest rates are still in negative in real terms, it's not correct, it's not sensible. And that's why, unfortunately, Madame Lagarde has to increase the rates in Europe much more than what she's done so far. In the US, we will not be far away from that next year. And when you are in a world where you have normalized monetary policy and differentiated monetary policy, this world will become much less correlated. And from a global investment point of view, that will make sense for you to be diversified, right? Because you will reduce your risk by being diversified.
That's interesting. So it's getting even more important because in the last years you said the correlation was very high, so it doesn't make that much sense in a world of negative real interest rates. Okay.
Yeah, once you have real rates which are becoming more positive, and because inflation is it's local, it's so it means that monetary policy will be much more local in a way. Then monetary policy is very, very important, whatever we say, right? And that makes the correlation, that makes the behavior of markets more specific. And if markets are behaving in a more specific way, they are less correlated to others.
Okay, so you have much more to do then later on because you have to pick up.
Exactly. But that's make our job more exciting. So that's I'm looking for that.
Thank you, Ms. Varnier. It was really interesting.
Thank you. Thank you for your time. Thank you for your questions.
Über aktuelle Börsenaufreger und Ereignisse berichtet Werktag für Werktag übrigens die kleine Podcast-Schwester der Geldmeisterin, die Börsenminute. Überall, wo es Podcasts gibt, auf YouTube, Facebook, LinkedIn, Xing und auch auf www.geldmeisterin.com. Eine erfolgreiche Anlagewoche wünscht euch die Geldmeisterin und Julia Kistner. Und am Schluss noch der Disclaimer. An dieser Stelle wie immer der wichtige Hinweis, dass die Inhalte dieses Podcasts, der Videos und der Webseite geldmeisterin.com ausschließlich der allgemeinen Information dienen und die ganz persönliche Meinung der Geldmeisterin und von Julia sind. Es handelt sich keinesfalls um Investmentempfehlungen, Rechts- oder Anlageberatungen. Das Gesagte, Geschriebene und Dargestellte kann und soll auch nicht das persönliche Gespräch mit deiner Finanzberaterin ersetzen. Auch sind weder die Geldmeisterin noch Julia Kistner informiert darüber, wie es mit deiner Vermögenssituation ausschaut, deinen Bedürfnissen, familiären Umständen, deinem Finanzwissen, die Risikoneigung oder deinen Anlagehorizont. Anlegen erfolgt daher auf eigene Gefahr. Die Geldmeisterin und Julia Kistner haften nicht für Anlageentscheidungen, die aufgrund ihrer Medienbeiträge getroffen werden. Kurzum, für die Geldmeisterin und Julia Kistner war es immer ein Vergnügen, dich bei deinem Vermögensaufbau zu inspirieren. Auf deinen eigenen, persönlich richtigen Geldesel musst du schon selbst setzen. Viel Erfolg!